The next stock I'm going to introduce is Netflix. Netflix Inc. has been a big winner this year with the stock up 65%, overcoming a disastrous 2022 in which the stock lost more than half its value. The new earnings driver, with significantly higher margins and increased free cash flow, is the meat of the plot. Additionally, a rebound in subscriber growth, including the success of a new ad-supported plan, helps explain the stock's current strength. Last time we NFLX coverage was in 2020 with an article hinting at what could have been a pandemic. Media hype of the time. In terms of actual value, the stock is still down compared to that bearish assessment. A lot has changed and it's time for an update. We're impressed with the change and look forward to seeing how NFLX returns to all-time highs next year. A number of favorable financial and operating factors support the current recovery continuing, and we expect current earnings estimates to increase. Ultimately, Netflix is a high-quality category leader that warrants a high valuation, and we view the stock as a buy. Netflix reported third-quarter results in October with EPS was $3.73, higher than Solidarity by 23 cents. Revenue of $8.5 billion increased 7.8% over the previous year. Global paid streaming subscriptions rose 11% to 247.15 million, an increase of 8.8 million in the quarter. The biggest increase since Q2 2020, at the height of the streaming boom gland. This region was the growth driver, adding 4 million subscribers during the quarter. An increase of 2 million subscribers in the core region of the US, Canada and Australia compared to an increase of just 0.1 million in the third quarter of 2022. Management emphasizes adoption of plans discounted ad support to capture 30% of new signups, exceeding internal expectations. At the same time, average revenue per member user globally fell -1% compared to the same period last year. The landscape here takes into account the changing mix of low-cost advertising plans as well as the occasional limited price increases over the past year. Stronger growth in emerging countries with lower average prices also added to the index's volatility. However, the trend was good enough to push up operating margins to 22.4%, the highest level in 2 years. Notably, marketing spend as a percentage of revenue, at 6.5%. In the most recent quarter, was down from 7.2% last year, reflecting some efficiency and affordability measures. Costing. Management is now targeting an operating margin of around 20% for the full year, at the top end of its previous target of between 18% and 20%. What we like about Netflix is the sense that following more than a decade of pursuing a growth at all costs type strategy, the company is finally bearing the fruits of its global scale with accelerating profitability. At this point, the streaming service in developed markets like the U.S. is hardly a novelty, and the market can start looking beyond subscriber growth as the key indicator. What's more encouraging is that churn or cancel has been low, even following steps to cut down on paid sharing. This aspect of high retention means that subscribers are committed to the platform and support a long runway for future growth. Of course, there is still plenty of room to capture signups in developing regions like APAC and LATAM, for example. But the bigger opportunity as we see it is for management to optimize its monetization. In this case, Netflix has a lot of room to work with in terms of adjusting pricing where many countries are still at a large spread to the U.S. standard plan benchmark of $15.49 per month. Between gradual price hikes expected over time and room for additional subscriber gains, the path is for the average revenue per membership to continue trending higher. Separately, we can comment on how Netflix has proven its ability to launch blockbuster franchises like Stranger Things and Squid Game from scratch. Along with multiple accolades, at a time when other media players are relying more and more on legacy properties. The interpretation here is that Netflix is rich in data on what works and that can translate into structurally higher margins going forward. Putting it all together, The path here is for climbing earnings from what has evolved into a cash flow juggernaut that may just be getting started. The insight we offer is that the macro picture could play into even stronger than expected results. In particular, we see a weakening US dollar, which has reversed course in recent weeks. Lower than expected inflation data, which forced the Fed to abandon its rate hike cycle, pushed bond yields lower while also pressuring the dollar. This is important for Netflix because the company generates nearly two-thirds of its revenue outside the United States. Looking back at the most recent quarterly report, management cited the strengthening U.S. dollar at the time as a drag on the company's fourth quarter outlook. In other words, the current turnaround supports higher earnings in the coming quarters, which is a favorable move for the stock. Looking at the stock price chart, NFLX is approaching the $500 price tag. It seems, must be the key factor. Technical support zone from 2020 to 2021 and currently represents some resistance. The possibility of a breakout higher here opens the door to a further return to all-time highs over the next 12 months. The next stock I'm going to introduce is TSMC. Taiwan Semiconductor Manufacturing, also known as TSMC, is the world's largest contract chip manufacturer. Many types of consumer electronics, including smartphones, laptops, tablets and gaming consoles, use Taiwan semiconductor chips, which is good for their business as they grow. Healthy global economy, but terrible as the global economy is slowing down. As global economic growth slows, consumer electronics sales decline and eventual demand for chips also declines. Unfortunately for TSMC, central banks around the world aggressively raised interest rates in 2022 and investors sold shares in anticipation of slowing revenue growth, which happened in 2023. The global economy is currently in recession, but this period of economic weakness will not last forever. While some economists remain gloomy about the global economy through 2025, Goldman Sachs Research estimates global economic growth will exceed expectations in 2024 and the manufacturing sector will recover. If Goldman's analysis comes true, TSM stock could recover as early as next year. This article will discuss the overall state of the chip manufacturing industry, the secular trends that could fuel industry growth for a decade or more, and how the market is likely undervaluing the stock. And why it's a big buy. Chip manufacturing. The industry is cyclical, meaning it fluctuates between periods of high and low demand. During good times, when chip demand increases sharply, TSMC is motivated to build new chip production capacity to meet growing demand. Often, it overestimates the required capacity. As demand for chips inevitably declines, TSMC has excess capacity. Because they produce fewer chips to meet reduced demand, their manufacturing facilities use less than 1% of total capacity, known as underutilization. Things are looking up for TSMC. First, although the chip manufacturing industry was under pressure all year, the company delivered, better than expected, results with a fast growth quarter. When it announced its third quarter results on October 19, investors were impressed after the company's fourth quarter forecast. Revenue of $18.8 billion to $19.6 billion, above analysts' consensus estimate of $18.33 billion. Another favorable sign was that the company's second biggest revenue source, smartphones, grew 33% sequentially and 15.7% year-over-year. A Zacks analyst blog attributed the strong growth to strong demand for the company's new advanced chip process, a reference to its 3nm process. Since Apple is rumored to be TSMC's largest 3nm buyer, it is likely to contribute largely to TSMC's smartphone growth in the third quarter. With one of the markets the company's biggest, smartphones and PCs are starting to recover, the semiconductor cycle looks to turn around in 2024. And shares are selling at lofty valuations. The market could give investors an early Christmas gift. I consider this stock a buy.